Well, what if one of the world's biggest money managers told you the AI revolution won't create abundance first, it'll create scarcity? Energy chips, power, capital, all in short supply right when the world needs them most. That's the provocative call coming in from BlackRock's mid-year global outlook, and it's reshaping how investors, governments, and CEOs are thinking about the next decade. And joining me now to unpack it is Ben Powell, Chief Investment Strategist for APAC and the Middle East at the BlackRock Investment Institute, and one of the authors of this outlook as well. Ben, welcome to the interview. Thank you so much for your time today.
Thank you, Aisha. Always great to be with you.
Right. Ben, your report says that markets have been using the wrong mental model entirely. What was the old model and why doesn't it work anymore?
Yeah, we think that we are in a completely different investment context. So if we think about much of the last 15 or 20 years, it's been, frankly, quite pleasant. Very low inflation globally, very low interest rates, and that led to something like an everything bull market. I'm sorry to tell you, we think that is over. We are now in a much more complicated world in many different dimensions. Clearly, geopolitics, the economic stuff, policy uncertainty. Really, it's a very, very long list. And what that's leading to is much more complicated and, frankly, confusing markets. So what we think is necessary is for investors to adopt a more appropriate toolkit, specifically being more active. We're all going to have to do more work and really pick our spots on precisely where we think the winners are going to be over time. And that's just completely different from kind of the old risk on and don't touch approach, which worked very well. That's over. It's now a time for active.
So, Ben, you point out to the scarcity as the defining force now, not the usual business cycle. Walk me through the structural shifts, the demographics, the geopolitics, all of it that convince BlackRock that this is a genuine regime change and not a passing phase.
We think this is a structural change which is going to persist for years to come. So this isn't just like for a quarter or two. This is a profound, long-lasting change. And the key point is supply is now really binding. And you can think about that in different dimensions. You mentioned demographics. India, of course, is a big exception to this comment. But thinking about China, many countries all over the world are seeing shrinking labor force, less workers, fewer workers, and that can be inflationary. Geopolitics, more complicated. That leads to tariffs, and unfortunately, it leads to actual wars. Both of which, tariffs and wars, are not good for business, not good for efficiency. That also leads to higher prices, higher inflation. And then perhaps the kind of story of the moment, the AI super boom, which is real and ongoing and is super exciting, that's leading to just incredible amounts of money flowing into relatively constrained spaces, be that chips, memory, power, all the way down to the copper wiring. We need to get the electricity from where it's created to where it's needed. This is a scarcity story. So AI, we're open to the idea that it can be an economic kind of boon in the years ahead. But before we get there, we're going to have to do the work to build the thing. AI is a physical thing after all, and that's going to take hundreds of billions, maybe trillions of dollars into constrained areas. We call them bottlenecks. And that's why we're seeing AI very much as an inflationary driver for now, adding to those others that I mentioned, leading to structurally higher inflation. We think that's going to run and run.
So off the big macro calls in this outlook that you've talked about, which one do you think the markets are getting most wrong right now?
I think the market, until recently, I would say, was really painting the AI story with a very broad brush. I think that's changing right now, actually. I think maybe hitherto it was kind of perceived to be really good for certain geographies and less good, let's say, for other geographies, including India, if we're honest about that, I think. We're now moving naturally for the markets to becoming more sophisticated as we learn about this technology and really working out which areas specifically are going to be winners, which are going to be losers. So I think one of the things that the market is evolving in a direction we would very much be aligned with is being much more specific. Being bullish AI, that's fine for dinner parties, but within the context of a portfolio, we need to be much more precise. That's something we think is happening, but we need to see more sophistication, more kind of work, frankly, in how we as investors and portfolio constructors approach the AI story, which is real. It's not like I'm saying it's not real. It's real, but we need to be precise. What exactly do we mean in terms of the investment implications? I still think there's work to do there. The markets are doing it.
So I want to talk a little bit more about this in greater detail. This abundance trade that one is seeing right now in AI, which you call inflationary before transformative. We're seeing that play out perhaps somewhat, and correct me if I'm wrong here. I mean, everything from NVIDIA, the big chip names, to SK Hynix, that derating as we speak is kind of playing out. Describe a little bit more as to what this inflationary environment, as you call it, is actually going to entail.
Well, I think what it means is earnings really matter. So the problem with inflation is it prevents central bankers from saving the day. So central bankers all over the world, including the Fed, the big one, I guess, they're just stuck because inflation is too high. So what we're going to have to do as investors is really pass through which companies are going to make money, which companies are going to make less money. So that's kind of a huge difference. We can't just rely on the benevolence of central bankers to ensure we have an everything bull market. We're going to have to be super focused on earnings and valuations, good old-fashioned fundamentals. I'm not really saying anything too outlandish here, I don't think. I think we had a strange 15 years of low, even negative interest rates, which created this everything bull market. We're actually, I think, going back to much more of a normal investing environment where we need to be much more focused on fundamentals. That means earnings, that means valuations. And again, really picking our spots by geography, by asset class, and by sector, where we think we're going to see companies flourish and benefit in general, and perhaps specifically as a result of this AI boom in the months, quarters, and years ahead.
So how would you describe what's playing out right now? I mean, from an investment perspective, does it tell you that the AI trade is finally being priced in rationally, or is this the first crack in the bubble?
I think it is a more rational environment. So the market is now, perhaps Korea being the poster child for this. We downgraded Korea back in June because we were a bit concerned about the very frothy nature of markets. I want to be clear, it wasn't that we're not bearish on Korea as an economy. We're not bearish on the memory space, which is a huge aspect of the Korean equity boom. It had just got a bit far ahead of itself, a lot of leverage in play and so forth. So we got a bit nervous and downgraded. And that call, frankly, has gone very well with the tremendous sell-off we've seen in Korea. Again, that doesn't mean that memory is not a good place to be over the longer term, but we need to be careful. We need to be much more precise and dynamic, not just kind of falling in love with particular holdings, being disloyal to our plays in a way and thinking about where the relative valuation is changing. So we are, for example, less favoring memory just on a valuation and kind of frothiness perspective, much more favoring the power space where we think the market is relatively underpricing the kind of potential from AI, which of course is very power hungry. So we're bullish AI. We're not particularly bearish Korea, kind of as a thought over the next many years, but we've got to be mindful of valuations, obviously, got a bit far ahead of themselves in Korea. So rotating into power, we thought makes sense, and that's going okay so far.
But talking about power and energy, Ben, your highest conviction trade right now, ahead of chips, ahead of memory, why is the market still underpricing that bottleneck?
I think the market is still working through just how difficult it is to create power. So we've got these various kind of political pushback in the US, and that's completely fine. We're just a humble asset manager. It's up to every country to work through how they solve for this situation. That's completely fine. But one problem, I suppose, is that AI is power intensive. That is a kind of big power shock, a demand shock in a constrained supply environment. We can't just click our fingers and create incremental power capacity, be that nuclear, be that renewables. I mean, that's years. It takes a long time to get the permitting, excuse me, yet alone building the thing. And there are shortages kind of up and down the power problem, all the way down to the level of the skilled labor. There aren't enough electricians to get this work done. So we think the market is aware that there's a power need, that's for sure, but we still think they're underpricing the supply problem. This is going to take years to resolve. Maybe it even is impossible in certain states, in the US, for example, for political reasons. I'll just say, kind of in passing, China's a very different kettle of fish, actually. China now has more power than Europe and the US combined. So when we think about the kind of power that AI needs, that's actually potentially an advantage that China has over time. So we want to be open-minded globally to where we can find these valuation opportunities, and perhaps very selectively that can include China because they've got the power relative to more difficult environments in other parts of the world.
You use the word polyfication, Ben, multiple plausible futures instead of one base case. What does that actually mean for how investors should be building their portfolios today?
Yeah, it's our favorite word. So what does it mean? Polyfication means many things can plausibly happen. So going back to that period of time, I talked about low interest rates and so on. That was called the Great Moderation. So, living was relatively easy. I'm sure it wasn't perfect, but it was pretty predictable. You could, as an investor or a central banker or a government, you could be quite confident that next year looks roughly like this year. It was just a high confidence environment. Now, as we're all acutely aware, it feels like anything can happen at the speed of Twitter, perhaps, geopolitically, economically, policy. I think it would be foolish, frankly, to pretend to be hyper confident that we all know what's happening 6 months into the future, yet alone 3 years into the future. So, of course, we have to make calls. We have to try and decide what's the right portfolio. But I do think in a what we call polyficated world, where there are many potential futures, we need to be even more humble than normal, even more ready to accept incoming data which shows that we're not quite right in our positioning, and to be more dynamic to make sure that we're keeping up with the changing state of the world. Because again, we feel this is, as the young people say, this is a feature, not a bug. It's going to persist. And we need to update our investment toolkit accordingly, not just kind of wishing for that great moderation. We all miss it. It was a great time, but it's over, and we need to adjust for a polyficated world moving forward.
But for now, would you say there is a mean reversion of sell software, buy chips, which is going to play out for a longer time to come?
I think there's a nuance here. So I think we've seen this AI excitement, which is now being worked through. It seems to me there is some risk, actually, of the emotion flowing too much the other way, with some of the AI, I guess, baby being thrown out with the bathwater to some degree. That's called opportunity. So if we still believe in the AI theme, which we very much do, if you see a kind of unwind, which obviously happens from time to time, that's fine. That's a normal part of markets. What our job is, as the world's largest asset manager by far, as professionals, is to bring our scientific toolkit to that and think about where this volatility is actually a good thing, in the sense that it's presenting opportunities. We're running our slide rule every minute of every day through these opportunities. The good news is there's a lot out there. Maybe the less good news is we're all going to have to work a bit harder to find them. And that's what we at BlackRock are doing all day, every day.
Fit in, Ben, when it comes to the entire AI stack? Because right now, India is a good hunting ground for layer 3, your picks and shovels of the AI trade. But again, these are not deep spaces wherein you can have the FI or FBI money flow in, because these are kind of shallow traded stocks. Having said that, do you think they can or have the potential to become much larger eventually?
I think so. Look, I think India is absolutely fine. The last 6 months has been a bit problematic, and I'm keen to say I don't really think India has done anything wrong. Perhaps valuations 6 or 9 months ago were a little bit full, but obviously India has been impacted by the war in the Middle East, as many of us has. That's not like an India fault in any way, shape or form. And clearly the AI super boom has played out more in other geographies, Korea, Taiwan, within emerging markets. That's fine. But when I look at India, The long-term structural growth story, which is very well understood, it seems to me and to us at BlackRock, is still completely true. That leads us currently to be, I guess, relatively more excited by some of the domestic plays, finance, autos, two-wheelers. If you look at that area, it's still pretty strong, it seems to me. I think the foreigners have been dipping their toes back into India in the last few weeks, maybe a couple of months, for two reasons. One is that the long-term story is still true. Valuations are a little bit better. And then strangely, Aisha, I think there's actually, if you like, a silver lining to not being so directly in the AI space. When we are constructing global portfolios, we want diversification. So we may be bullish AI, but we don't want to have all of our eggs in one basket. So India is, for now at least, a kind of a different thing. That's a good thing within the context of a global portfolio. So when I look at India, valuations are better. Sentiment is much less constructive. That's a good thing when I'm thinking about incremental kind of opportunities. And most importantly, the domestic bull story, the domestic growth story on a continent-sized economy continues to be unique on the planet. And that's why we at BlackRock are very constructive India over the longer term.
Interesting. And how did you read into the Fed's latest move? While it held fire, inflation is still above target levels and the US economy is holding up, but are central banks actually on hold, or are they just waiting for cover to move? Because there was that hawkish undertone in the commentary.
Yeah, it's super interesting, really fun. So central bankers had a pretty, I'm sure they're all extremely sophisticated, don't get me wrong, brilliant people, but they had a relatively easy time of it during the Great Moderation, where inflation was no problem. That gave them total room for maneuver to come in and save the day at the first sign of problem for growth, employment, or even financial markets. Now they're much more hamstrung in a polycated world. So it isn't just investors who are trying to work out what's going on. Central bankers are as well. The Fed is doing that very formally. They've announced and are beginning to bring together 5 task forces to really, philosophically and intellectually interrogate how does the Fed set policy. That to me seems like a very wise thing to do, recognizing that the world is fundamentally different. So I think when I look at the Fed, they really want to do the work and then set policy kind of once they've got a more confidence in their own framework. That's going to take a bit of time. So I think they are keen to sort of wait and see. The problem they've got is the markets is going to challenge them. That's what markets do, is kind of test central bankers. What are we up to here? And I think that's what we're seeing at the moment with yields moving high. So the Fed and other central bankers are going to try and wait and see. But the market's going to, I think, continue to challenge them, given that, to your central point there, inflation is too high. That's just true. And central bankers, they have a mandate. That means mandatory. That means they can't ignore that. So how they square that circle of waiting for more data, doing the work on the task force, but of course, still minding the store on inflation, that's very complicated. And we are, how can I say, we are very mindful that they're in a more complicated world, much as we are as investors, because the world is genuinely more confusing. We just think that's a true fact.
So overweight China, overweight India, and equal weight US. Am I getting that right?
Neutral China. So neutral, I think, is a misleading word. What neutral? I would rather use the word selective. So we absolutely, within India, within China, we think there are headwinds and tailwinds, and that's kind of a good thing to pick our spots. So we really think, I made the point kind of at the global level, also within geographies, we'd want to be selective. To be straight, we are neutral China, we're neutral emerging markets, India would be a part of that, and we're overweight the US. So those are our formal recommendations, excuse me. But again, I really want to belabor this point. That's at risk of obscuring the whole kind of point. I think the main point we're making, which this is a time which is going to reward hard work and really thinking at the sector level, even the individual company level, who's going to make the money, who's going to make the earnings, who's the right side of scarcity, who's the wrong side of scarcity, and positioning portfolios accordingly in a much more active, selective way. That's the real message that we want to put across today.
Other than geographies, Ben, it's also, or rather what the last year and a half has taught us is also about diversification into different asset classes. Gold, silver, you can't ignore them anymore. Crude, Bitcoin, digital dollars, the future of currency. Where does BlackRock actually stand on the other asset classes?
I think they're all important. So I think, unfortunately, the easy days are over. So in the old days, you could have what many people refer to as a 60-40 portfolio, 60% equities, 40% bonds. And that worked beautifully in the old days. It was totally appropriate. It was glorious. Again, we feel that we're in a totally different investment paradigm, and we're all going to have to work harder across every dimension. Correlation, diversification is harder now. We're seeing inflation much higher. That means interest rates go up as a general statement. That means bond prices are generally trending down. I'm painting with a broad brush here, not all of them, but it's a very different situation from a 40-year bond bull market that we all very much enjoyed. That's now over. So when I think about income as an example, we do think it's necessary to look a little bit further afield, be that in private markets, be that in emerging market, local currency debt, and so forth. So I think an important point is we're all going to have to be more open-minded, I guess. What are the assets we need in a portfolio to help us achieve our portfolio goals, be that funding one's own kind of children and healthcare challenges and so forth, all the way up to kind of running a sovereign? What are we trying to solve for? And then what do we need in the portfolio? We just think it's very likely that the kind of number of assets, the range of assets is going to have to be wider. We're going to need to own more different things to achieve portfolio goals. You named a few of them. We'd also really want to emphasize the importance of private markets. They're still called alternatives by many people. I have to tell you, I think we're going to need to rebrand that at some stage, because they're an increasingly mainstream part of every conversation we're having all over the world. I think it's fair to say.
So as we wind down, Ben, what do you think the world is most short of right now?
I think the world still wants to believe in the old days, the good old days. Surely we're going to go back to the great moderation. Surely inflation, always goes down, and the Fed can always save the day. So I think what we're short of is acceptance. We need to get through the 5 stages of grief for the great moderation and accept we're in a new paradigm. Maybe we're sad about that, but that's not helpful, right? We need to be pragmatic investors, accept that we're in a more complicated world, and just adopt a more appropriate toolkit in some of the active, dynamic, more flexible ways that I've tried to explain here. So what we're short of is acceptance, the need to do the work, and the more active approach to investing, which we think can work and help people achieve portfolio goals over time.
Philosophical as well. But Ben, plenty to think through here. Scarcity before abundance, power before chips, and a lot of humility built into your models. Thank you so much for your time today.
Thank you.
Thanks.